promised, in this video, I'm going to be talking about the trade where I lost $15,000 early on in my trading and how big a mistake that was and how you can avoid the same mistake. Coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and live your best life. I've talked about trading stocks quite a bit already on this channel. We'll be talking about it more. But early on in my trading, I made one trade where I lost $15,000. At the time, that was more than a third, or right at a third, of my entire trading account. And it was devastating. And so when you really think about that kind of loss, one of the first things that you really want to do is go back and evaluate it. And that's what I did. I stepped out of trading for a year. It was so painful. That loss was so painful. I stepped out of trading for a year. But I really thought about things. I really considered what I did right, what I did wrong before I stepped back in. And those findings are what I'm going to share with you. Now, when we talk about this trade, what I did was, when I initially got into trading, I'd been a financial advisor way back 20 years ago, and I got into trading. I had a check for $4,500 from leaving an employer, and so I decided to take that money and start trading. And I decided to do short-term trading. And when I say short-term, most of you know that these days it's called swing trading. Wasn't called that back then. Swing trading and or day trading. I do much less day trading. I rarely day trade. Most of what I do is swing trade. That means I will trade a stock or set of stocks every few days, every few weeks, every few months, less than a year. I usually hold them less than a year. I took that $4,500 and over the course of a year, I grew the account to $50,000. Now, most people would say, hey, that was a great return. And it was. It absolutely was. I was so thrilled, so excited. But what happened was I had convinced myself I was so smart and I had done so many things right that I almost couldn't lose. Huge red flag, by the way. But I found one stock that I thought, okay, this one's going to be the big one. This one's going to be the winner. I'm going to swing for the fences on this one. Huge red flag number 2. And so I invested $25,000, half of my account, into that one stock. A huge position given the size of my account. Red flag number 3. Well, that stock immediately started heading for the basement. And I don't mean just a little bit. It took a dive. And I just kept thinking, oh, but I know it's going to come back. I know it's going to come back. And I convinced myself my original decision was correct. I convinced myself, despite all the evidence to the contrary. I held on to that original decision. And I held on to that loser because my ego didn't want to accept I was wrong. Huge red flag number 4. Then I decided, well, if I buy a little bit more, it will lower my average and it will be much easier for that stock to come back and for me to make money. So I put in more money. I put in almost my entire account, a little over $40,000 I put into this stock. It continued to slide. At that point, I finally, thank God, came to my senses after I had lost a third of my money. And this happened fast. Within a week, I had lost a third of my money. And I finally sold out of the position and took my lumps. Thank God. It kept going down. I mean, that stock lost 90% of its value. So I saved myself something, but it was so painful. And it wasn't necessarily painful because of the amount of money, although that was incredibly painful. Because at that time, when you have a $50,000 account, $15,000 is a lot. You know, especially when you spent a year getting there. And so it was very, very painful. And I stepped out of the market. And I had several things going on in my life. I'd moved, I'd done several things. And so I was also working, and so I just set it aside for a year. It was very painful, and I really didn't want to jump back in until I felt like I was ready. Well, in evaluating what I did right and what I did wrong, mostly what I did wrong, with that trade, it gave me a set of principles, and that's what I trade with today. And there are 5 key things that I watch out for, so I don't make that mistake again, and this is what you need to watch out for too. The first one, position size. That is a big one for me. If you're trading an account that's even $1,000, position size is very important, because if you invest too much in one stock, it could murder your account. Absolutely. I always trade at least 4 to 6 stocks within any account. It doesn't matter the amount of the account. If you have $1,000 account, then you shouldn't be putting, in my opinion, more than $200 to $250 in any one position. You want to choose differing sectors, biotech versus tech versus, retail versus whatever. So you're not overexposed to any one area. That is just basic financial knowledge, that you diversify yourself at least somewhat, even with a small account, so that you don't get sacked on one trade. You want to go for the incremental gain and the constant profit. You don't want to go for the big one. So that's how I divide it up, and I still do. It doesn't matter the account. If you have a $50,000 account, maybe you devote $10,000 to each position. You don't want to have too much on any one trade. Number 2, have a trading plan and stick to it. A trading plan to me consists of what you think the long-term prospect for that stock is. I like stocks that are upwardly trending over time. It gives me a general direction. I also write down where I want to get in to a position, where I think would be good to get out of a position. And here again, you got to stick to it. And I plan to make somewhere between $300 and $1,000 a trade. These are small. That's not big. But here again, it's not big risk either. I'm not risking the farm. If you have a $1,000 account, and let's say you're investing $200 in each position, if it goes up 10%, that's $20. Be happy with your $20. Take your $20. Don't beat yourself up because you haven't made $1,000 on a $200 trade. Don't do that. Just really adjust your expectations and don't try to swing for the fences. Stick to your trading plan. That way, if that stock drops below a certain amount, and you pick the amount before you buy the position, but let's say you're not going to go over a 15% loss, or you're not going to go over 10%. Is pretty low. I'll give you that, because stocks will often swing up and down. They can easily swing up and down 10%. But maybe you set it at 15%. Maybe you set it at 20%. But you have some sort of stop loss where you're not going to lose a ton of money on one trade. And you don't allow yourself to go beyond that. That trading plan will keep you out of trouble. It will keep you from becoming an emotional investor, because that is a mistake. Your emotions are not good when you're trading, because they'll convince you you're right. They'll convince you a stock's always going to go up. They'll convince you of all kinds of things that aren't true. You have to look at data. You have to look at what the stock is doing. You have to look at the news. You have to look at all these things that are not emotional, and make your decisions and your plan and stick to the plan. Number 3, practice humility. Do not allow your ego to convince you to hold on to a loser. Don't do that. It is better to get out quick. You can always get back in. If that stock continues to go up and you feel like, okay, maybe there's more to be made there, you can always get back in. But there's no reason for you to hang on to a loser, especially if it goes beyond the loss that you want to accept on your trading plan. Do not allow your ego to convince you to step outside of your own rules. Let me give you an example. You hear about a great stock and it's going to make 20% in the next 10 days. Great. That's awesome. But don't allow that news or that possibility to convince you to put a whole bunch more money into it. Maintain your position size and take the profit, if there is any, and be happy with it. Your ego getting in the way and you thinking you're the smartest person in the room is going to trip you up every time. I guarantee you, you're not the smartest person in the room. Big guys on Wall Street aren't always the smartest person in the room. So you've got to have some humility and realize you are going to be wrong. And you want to protect yourself from the times you are wrong. Number 4, patience is your friend. You can afford to be patient. You don't have to be in the market every second. You can step out. One thing that I do tell people all the time is if you are going to be otherwise occupied, you're going on vacation, you're going to your best friend's wedding, you're going to a family reunion, you have an emergency come up, get out of the market. When you are distracted, you're not going to make good decisions. You're going to get very frustrated. The people you're with, even if those people are people you love and want to spend time with, they're going to get irritated that you're constantly distracted. Do not allow trading the market to take over your life. Make rules that allow you to have a life, and what the market is or isn't doing isn't going to change your life. There are times I'm completely out of the market. The holidays are a good example. I'm out of the market. I want to watch Christmas movies. I want to enjoy Christmas. The market kind of takes a dump at the end of the year anyway. It goes into these lulls. Yeah, I don't care. I want to be out of the market, and I don't care what else is going on. You need to have those times of clarity, especially if you've gone through a time where you've had several losses in a row. Sometimes it's good just to step out for a while. Get away from that stress. Get your head back in the game. Patience is a good thing. There's no such thing as missing out. There will be an opportunity tomorrow, just like there was an opportunity today. There is no such thing as missing out. So don't be afraid to step out of the market. And number 5, and this is a big one, if you are going to be a profitable trader long term, you have got to be willing to leave money on the table. Now here's what that means. You will never, even within the course of a day, a week, wherever that stock is trading, you will never know what the exact high is going to be. You're never going to know what the exact low is going to be. You have got to be willing to trade the range and wait for confirmation before you trade, and that's going to mean leaving a little bit on the table. So be willing to leave money on the table and be happy with just a percentage profit every single day, and you'll be much more profitable than that guy you hear at the bar that's talking about, how he hit the big one. Because I promise you, the next day he probably lost a big one too. Because that kind of trading will never suit long-term profitability. If you have found this video helpful, please click subscribe, and I'll see you next time.